George Elmore, committee member.
Paul Dumars, committee member.
Bill McDaniel, committee member.
Mike Burke, CFO.
Blair Littlejohn from the Office of General Counsel.
Jack Warner, Finance Committee, citizen volunteer member.
Ron Horan, Treasury.
Brenda Giampetti, Treasury.
Jason Heumann, PFM Asset Management.
Scott Stitcher, PFM Asset Management.
Leanne Evans, School District Treasurer.
Rick Miller, Finance Committee. And we have
Rick Patterson with Raymond James. Matt Williams.
okay, welcome all. Approval of the agenda is the first matter.
Second.
Any objection? Agenda is approved. Approval of minutes of December 14, 2018. Do I hear a motion?
So moved.
Or are there any comments? Second? Yeah. All in favor?
Aye.
Motion passes. And then the approval of public comments now. We've got a big public here today. Do I have anything to say? Okay. Our discussion items, the quarterly investment report. Yes, that is.
Good morning.
Or is that,
Yeah, Scott's going to do a lot of it. Jason may chime in, and I'll chime in on the district portion. I just wanted to give a little bit of preview to the meeting today. We have the quarterly investment reports and then a review of the policies, which we did that at the last meeting, and I promised to bring them back with all the changes that were made. So we'll go through those briefly. I have a short presentation to summarize the changes, and then we can certainly jump into the policies themselves if necessary. We're going to do the core portfolio and then dig into the other. There was some interesting things that went on the market in December that did impact the portfolio, so I want to make sure we covered that today. And so I'm going to turn it over to Mr. Scott Stitcher to get us started.
Mr. Wow, we're getting formal this
It's
morning.
Friday morning, I don't know.
Thank you, Leanne. Good morning to everybody. Happy
Sure, if that'll
Friday.
work. Try it. I think because it's a PDF, I think I'm going to have to do it.
Oh, okay.
Or you can do that.
Okay, fair enough. Thank you. So the fourth quarter was not for the faint of heart. We saw surging volatility globally during the fourth quarter. We had a worldwide equity sell-off. We saw the curve, the yield curve, invert slightly between the 2 and the 5-year Treasury yield. We saw trade tensions continue, and those talks have continued into the new year. And lest we forget, the government was actually shut down during the fourth quarter as well, which some believe was going to impact fourth quarter GDP, but it doesn't appear to have really done so, as we got the first reading for fourth quarter GDP yesterday, and it actually surprised to the upside. So it was a very interesting quarter, and as Leanne alluded to, a lot of that did impact the performance of the portfolio. And I'm going to speak to a few slides that will help you better understand why that was the case. So I'm not going to spend a lot of time here on the first few slides because the story continues to be very positive. GDP growth, you'll note the Q2 and Q3 were the strongest readings we've seen since Q2 and Q3 of 2014. And then I mentioned the initial reading for Q4 coming in at 2.6%, surprising to the upside. Advanced estimates were 2.2%. So growth continues to be positive. The unemployment picture as well continues to remain very positive. The unemployment rate now stands at about 4%. So that's one of the Fed's mandates is full employment. It appears as though the Fed has reached that particular mandate. Their other mandate is to keep prices in check, keep inflation in check. And again, the fact that they've raised rates now 8 times, it appears as though inflation remains in check. It's now dipped a little below the Fed's preferred target of 2%, which again will allow them to sort of sit on the sideline for the time being. But again, inflation remains in check. So all this is positive for the overall economy. We think that we'll continue to see moderate and steady growth, and the Fed has indicated they will be very data dependent in the actions that they take going forward. So let me speak to what went on during the quarter and how that influenced or impacted the portfolio. And I want to start here and talk. I mentioned the global equity sell-off during the fourth quarter. You can see it graphically here, the impact of the S&P sell-off, down roughly 14%, we'll call it, during the course of the fourth quarter to end the year, down a little over 4%. And the same story can be told across the Dow, across the NASDAQ, and then looking out internationally as well. So this market turmoil, this global sell-off in equities, flowed through to the fixed income markets. And what I mean by that is we saw a real flight to quality. The demand for Treasury securities increased dramatically. When demand for Treasuries increased, that drives prices up and it drives yields down. And that's what's reflected on the chart over here to the right. The 2-year, which is a good proxy for your portfolio, was down roughly 33 basis points. So we just did an annual seminar, and I polled the room and asked how many people thought interest rates were going to fall during the fourth quarter, and I was glad to see that no one raised their hand. The Fed raised rates during the fourth quarter, another 25 basis points, yet interest rates proceeded to fall during the quarter. Again, that was driven specifically by the turmoil in the equity markets. So this is the first key point I want to make, was equity market turmoil led to Treasury markets rallying and yields falling. You'll keep in mind when we get to the portfolio that we've been maintaining a short duration stance, meaning we wanted less interest rate volatility in your portfolio, and that has served you well over the last 4 quarters, but it worked against us this quarter, and I'll point that out again more clearly when we get into the portfolio. Let me stop there and just see if there are any questions at that point. So, seeing none, with that said, I'll also point out with that equity market volatility and the rally in Treasuries, what we saw also was a widening of credit spreads. So what that means is a backup in yields in corporate notes. And a backup in yields means those prices fall. So this is the other point I wanted to make as being impactful to your portfolio. You'll recall we hold roughly 20% in corporate notes in the long-term portfolio, and this worked against us, this widening of spreads. The good news is they've started to come back in. So January is a very different month compared to what we saw taking place in the fourth quarter. So rallying Treasury yields, falling interest rates, credit spreads widening, corporate notes, all were impactful to the portfolio during the course of the quarter. I'll stop there again, just see if there are any questions, see if that's clear. Okay, seeing none, then let's go to what you're really most interested in seeing, and that is performance. And I'll stop briefly here to just to look at some of the portfolio statistics before we move to performance. So we ended the quarter with a market value of $40,644,474. And I'll point you down to the yield at market, yield at cost. Kind of exciting to see we're now north of 2% from a yield at market standpoint and approaching 2% from a yield at cost. We'll look at a slide here a little bit later, but you'll note the duration at 1.5 years. Again, I'll talk about how the duration of your portfolio did impact performance in a moment. Overall credit quality, AA. I like to point this out just because your policy says you have to be A or higher by 2 of the statistical rating organizations. I want you to know that what we show in this report is S&P only. You're not out of compliance with your policy here. The couple names that carry that BBB rating by S&P are Goldman Sachs and Morgan Stanley, which are rated A by Moody's and Fitch, meaning, again, that you are within the guidelines set by your policy, so no issues there. You'll note the breakdown of the portfolio. I mentioned that 20% allocation to corporates. was impactful. It was a quarter in which being diversified really worked against you. If you had a portfolio of 100% treasuries, your performance would have looked relative to an all-treasury benchmark quite good. But it was a quarter in which diversification, unfortunately, worked against you. Let's move forward here. I'm going to go to this slide as it is reflective of the last 4 quarter ends, as well as on a 1, 3, 5-year basis, and we also show you performance on a gross and net of fee basis. So, talked about what went on in the markets this past quarter and how this shows you how it impacted performance. So, in absolute terms, the numbers look quite good. The portfolio was up 0.98%. Unfortunately, the benchmark was up 1.29%. So we did underperform during the course of the quarter to the tune of about a negative 0.31%, underperformed by 0.31%. Again, that driven by the short duration stance and the credit exposure in the portfolio. Now, with that said, I do want to point you out to the 1-year number. Despite an underperformance in the fourth quarter, for the trailing 12 months, the portfolio still looks quite good, up almost a full 2%, 1.99% versus the benchmark at 1.58, with 0.41% of outperformance on gross fee basis and 0.33% on a net of fee basis. Okay?
I just wanted to make sure we went over this very carefully. We've never underperformed the benchmark like that. I mean, I've seen it 1 or 2 basis points occasionally. We're usually well in excess of that benchmark, so it's something very different for us. I understand why it happened. It's market-driven, and our benchmark is solely treasuries while we have a more diversified portfolio. So one of the questions I had asked Steve Alexander when this came up is, should we look at a different index that more closely reflects what we do in our portfolio? And his comment was no, because there are times when we do have a lot of treasuries. So he thinks it's still a good benchmark. This is just an anomaly.
Again, what was the reason? Was corporate, or is a concentration of corporate that's more than normal, or is it just that we have that concentration?
Not more than normal. It's the fact that we have exposure there.
Right.
And corporate spreads did widen during the course of the quarter. The bigger thing is this right here, this duration stance of 1.5 years versus 1.81 years. So that means we have less interest rate sensitivity. When interest rates fall, you really want more interest rate sensitivity, right? You'll participate more in the market when interest rates fall and you have a longer duration. Now, again, we've positioned the portfolio to be a little more defensive with interest rates rising and with the anticipation of the Fed taking action in the fourth quarter to raise rates again, which they did. No one really anticipated interest rates falling, especially to the magnitude that they did, 33 basis points. So honestly, we probably would prefer to miss to the upside, which we did here, than we would to the downside. Mm-hmm. So our more conservative bent did mean we did not participate as much when the market rallied during the fourth quarter. So in absolute terms, again, the portfolio was up almost a full percent, and that's not an annualized number. So, if you were to annualize that number, you're looking at a 4% return. Please note, I'm not saying that's what you can expect to return over the next 12 months. But just to kind of put it into perspective, I just wanted you to know that that's a pretty big move in one quarter, right? So again, it really was the duration stance, first and foremost, which I also want to point out, that's not where we feel we add value when managing a portfolio. We really tend to focus on sector selection, identifying the relative value in a particular sector, and then identifying individual issuers within those sectors. We rely less on duration. We don't want duration to be the key driver of performance in our clients' portfolios. And this quarter is a perfect example of why that is, because no one could anticipate yields falling and to the magnitude they did. So, again, we tend to take less duration bets in portfolios because of that uncertainty with interest rate moves.
Is that going to affect this coming quarter?
Well, this coming quarter, actually, the markets have settled down a little bit. credit spreads have come in a little bit. We can show you a slide a little bit later if you like to look at that to kind of confirm what I'm saying. And your portfolio quarter to date through February 21st is up about 0.49% and outperforming your benchmark by about 0.20%. So we've gotten, we'll call it 2/3 of the underperformance in the fourth quarter back in the first quarter of 2019, the first 6-7 weeks into 2019.
What's the duration at the moment?
At the moment, I have it at about 85% of the benchmark. Could you do that math for me real quick? Sure. 85% of 1.81 years. I'm going to guess it's in
That's
the
probably about 1.5.
I was going to say it's probably about where it is right now.
That's what it sounds.
Does that sound about right?
I mean, normally we expect as interest rates are rising, this was the position that we all took, and we knew we did it, and it's worked for us every quarter before. It's just no one expected the markets to do what they did in December.
Yeah.
So,
Well, that's an anomaly, but is that the right?
It was. It really was.
Is the effective, is that period duration, is that the right one for us? I guess that's the question, the 1.5.
Yeah, I'm going to do
Nobody
1.5.
had a very happy time in the fourth quarter. I mean, it doesn't matter what you were investing in. So, I tend to just. I'm more interested. What's your perspective now? I mean, are you going to stick with the 1.5 year duration, or are you going to move it out a bit? I mean, it's a function of what you think the Fed's going to do.
Right.
I mean, they practically announced that they weren't going to do anything, but circumstances do change. I understand that, but I mean, given the fact that they said they're not going to, and the market doesn't suggest that they are, would it be make any sense to move the duration out a bit?
That's the question.
That's exactly what we're trying to do. So to your original question, where's the duration today stands at about 1.54 years. So we have started to increase that. And again, to your point, you're exactly correct. The market, as well as the Fed, has really indicated that they're more than likely not to raise rates in 2019. So with that sort of indication and that uncertainty, we are more comfortable now moving towards what we'll call a neutral duration stance. So as maturities occur or opportunities present themselves to sell a security and reinvest, we are going to attempt to move the duration more in line with the benchmark going forward. So that's a great question.
one of the things that we've discussed, I've discussed with PFM, is increasing the core portfolio over the course of the year. Remember, a few years ago, we shrunk it, and it used to be $80 million, and we brought it down to about 40, 45, and we're going to be moving it up to about 60, 65 over the course of the year. So we're coordinating with them with the short-term portfolio. As we have maturities and we may reinvest, we may move that over to the core, and we're going to try to time that to do it at the right time and move those into the core portfolio to further out the duration.
What does it all mean in terms of dollars? In other words, how much are we making on this?
Our interest earnings overall for the year, I just gave this to the superintendent the other day. Our interest earnings through December, actually through January, for the general fund alone are $4.4 million. Last year it was 5.5 for the entire year. And our cash portfolio really kicks in starting in December. So we're going to probably double the interest earnings that we had over last year. So overall, we're performing very well. Wow. This is just a comparison to benchmark, and we're going to talk a little bit about the short-term portfolio in a few minutes. But this is really comparing to the benchmark. The benchmark was solely invested in treasuries in an instance where you had a massive flight to quality. And so that, it was just that's what happened. Our duration was less. Our portfolio was more diversified. And again, I go back to wondering if the index, if we should do something that's a more diversified index. And I'll continue to have that conversation with PFM. And I may be bringing that back. We'll talk again. They've said no, and I want to continue to talk about it. Because if we're investing in something that's more diversified, and that's what we normally do, should we try to find an index that reflects that? And maybe or maybe not. We'll continue to talk about it, and if we do decide to do something, we'll bring that back in
What's the
April.
standard index? Is that what you're using, basically?
That's what we're using.
That,
Right.
rather than having a
Yeah.
more tailored index?
So I'll
Probably
just
the right way.
I'll add to that, Leanne. You know, so the thought process behind this index is the fact that, you know, state statute mandates safety of principal and liquidity, and this benchmark reflects that
Right.
Florida statute mandate. We also say that, you know, when you add a benchmark that incorporates corporate, that's saying that you are committed to utilizing
Right.
corporate in perpetuity. And there are going to be periods of time, and you could probably point to 2008 to be specific, where we may not be committed to corporates, right? So then your benchmark would look a little different than the portfolio. But from a duration standpoint, a safety standpoint, a liquidity standpoint, this benchmark tends to be reflective of what we're trying to accomplish for the
Right.
school district. But it's a great question. Can you show it alongside of it? Sure. Why not, right?
Right.
So to your point, Leanne, you had mentioned let's take a look at the short-term portfolio. Unless there's something else you wanted to touch on in that.
No, the short-term portfolio, I just remind the committee that tax revenues come in December. So we did a tremendous amount of work on the cash flows and to come up with the right structure of this portfolio. And it was challenging to get everything purchased in fact, we didn't get everything fully invested by the end of the year. The TAN proceeds we got done in January. There was so much going on in the market. It was hard to find people that were issuing debt. So it was definitely challenging this year. But at this point, this is as of the end of December. Today, it's over $800 million that's invested. So we've invested $200 million more at this point.
Yeah, and I'll point out, I'll pat you on the back here, you timed it quite well. If you'll note your yield at cost at a 2.52%, and the yield at market now at a 2.07, so basically yields have fallen since you've put this money to work, so you've timed it. I know you're not a market timer, but the markets have cooperated with you quite well. You'll note the average duration inside a year, really at a quarter of a year. You know, the effective benchmark yield, just again to put that into perspective, about 2.3%. So very nice timing, all high credit quality. And then again, diversified across Treasury agency and commercial paper. So again, very, very nice timing. I don't know is there anywhere you want to go within the short-term portfolio?
No. Just go through it like you normally would. I'll add to it with the other report.
Okay. So again, you can see it, how it's invested. I just mentioned the breakdown of the portfolio. There's really not a whole lot more to add. The yield at cost being very, very
So it's
attractive.
mostly commercial paper, by far commercial paper?
I'm sorry?
It's mostly commercial paper by far?
It's actually about 42% in commercial paper.
Okay.
The larger percentage is in Treasury and agency. Okay, 46.9% in Treasury, 11% in agency. But again, very high quality, A1, A1 plus, two highest ratings by S&P. And again, very short duration, inside a year, about 0.22 years from a duration standpoint. So stuff will be maturing within the next.
This money all comes due. It's all by the beginning of August, I believe. They're laddered out. And I'll show you another chart that shows you what the thought process was regarding the maturities of these transactions in just a minute.
Yeah, so here you can see the transactions during the course of the quarter. You can see the yield at market out here, which is basically equates to the yield at cost at the time of purchase. So how do we get to that 2.52%? Well, it's a weighted average of all these yields. And then here's your maturity dates here, Leanne.
What happened in 2007, 2008 with the commercial paper?
Well, boy, let me test my memory here.
And it had to be a difficult time for commercial paper.
Yeah.
So I
Highly
just,
liquid and
Yeah.
there were people, I mean, General Electric, we've gone broke. They should have gone broke.
Right.
Maybe.
What you find today, there are
CP,
much fewer issuers of commercial paper.
yeah.
the headlines were really rocked by asset-backed commercial paper in 2008. But there was, again, 2008 was this true flight to quality. So anything outside of treasuries did not do well,
Yeah, that's what I'm
and was
thinking. And so
difficult
that,
to trade.
Yeah.
Yeah, but we're in a different world today. Again, there's much fewer commercial paper issuers. Asset-backed commercial paper is virtually dead, but we weren't playing in that space anyway.
That's the
so.
bank-rated commercial paper backing. I guess that's what you're talking about, asset-backed commercial paper.
Not necessarily just bank rated, but truly an asset backing.
Auto loans.
Auto loans.
Auto
Right.
loans.
The ones, at the
Credit
last
card
meeting, we
loans.
decided not to invest in.
Yeah,
Yeah,
okay.
thank God.
Yeah, when I hear commercial paper and I think of the downturn, that's what was
Well,
causing me some
Yeah.
reflection.
You know, the Federal Reserve stabilized the commercial paper market.
Mhm. Okay.
Okay.
That's all. I think we should at least show the asset allocation slide just to show that we are in compliance with
Right.
the district's policy. The gold bar represents the amount permitted by policy. The blue, the actual allocation. So I view this sort of as a gas gauge. Only in this case, you really don't want a full tank, right? You still want to have the ability to be nimble and move between sectors. So we'll just kind of end there with the fact that you are within compliance of the policy. This is by sector, and the following pages are by individual issuer. Again, no issues to speak of. Okay? That's all I have as far as
I
prepared
don't think you
remarks.
have anything to be particularly ashamed of by any means.
Yeah.
I think everybody had problems in both the debt and equity markets in the fourth quarter.
Thank you. I appreciate that.
Yeah. And I concur. I just wanted to make sure it's something different that we haven't seen before. So I wanted to make sure we had this discussion with the committee. Okay, now I want to bring up the short-term portfolio. Let's see if I can grab that. This one. Okay, this is the district's version of the quarterly investment report. So we're looking at the entire portfolio, and we're giving all the benchmarks. We can track it. Interest earnings to date through December were 1.6 million. Tax collections are slightly less than last year. It's only off by 1%, so it's very close. And this just goes overall where we're at. We have 1.4 billion total under management right now. We did make some changes to the charts back behind. And I want to skip over to the next slide. We've changed the way we're showing the investments so they mimic, they're doing it by fund. So this is the core portfolio first. And then we break it out and go to there is a small portfolio at Bank of New York. This is the debt service payments that were being made on February 1st. So money was with our trustee. And then we get into the short-term operating fund and how it's broken out. So we're looking at it, and let me see if I can make this a little bigger still. We have money in the Florida Prime for the first time. I told you all we were going to put some money in there, and we did. Not significant. And to give you an idea of where we were at in December trying to get this portfolio placed, Florida Prime would only take $50 million. We tried to put 60 in, and we couldn't buy it. And with Fei TF, we were putting money in there, and they said, you've hit the threshold of 15% of the pool, no more. So we had some challenges, and I appreciate the fact that the pools will do that. I think Florida Prime was just reacting to the market. Fei TF was looking at the diversification of who were their largest shareholders, and they don't want anyone to be more than 15%. And I don't want to be more than 15% of the pool either. So when they told me I was hitting that threshold, I said, okay, thank you very much for letting me know. I want to know that going forward. So it was good. It was hard to get money placed, though. I had more money in the bank than I wanted. I wanted to get more money invested. But there's only so much we could do. And I do want to flip over.
Now, why is it that Florida Prime wouldn't take more than $50 million when you have this?
I think it was going in at the same time there was all the instability in the market, and that's just all they would take that day.
Oh, they couldn't invest it?
Right. And it was going to negatively impact their returns. So, and we just haven't gone back to put more in there. One of the things that, and I'm going to not spend a lot of time on this, but I wanted to bring this up just so you can see the process that we go through when we're doing these cash flows. And I think I brought this up once before, but we have this massive spreadsheet, and we track, you know, every deposit, whether it's coming in, where the money's coming in from, if it's the workforce development, FEFP money, you know, all the different funding sources are here. And then we also have all the expenditures, whether it's payroll or accounts payable, and we're tracking every single transactions in and out of the bank account, in and out of our accounts. And then over to the far right, we're actually tracking for compliance purposes to make sure we're not exceeding the thresholds. So we're monitoring that every day. And what I do with PFM when we get ready to do an investment, I call them and ask for rate indicators. And they're yellow only because that meant I updated them, but we get rates for what different, they give me what they expect the rates would be for different maturities. And this was as of in February because we did some reinvestment. I do it net of fees, and then I compare like the commercial paper versus FEITF, their term product, which we can invest longer. So I'm looking at those rates, looking at the bank rates net of FDIC. So I'm comparing all those things and then trying to figure out where to invest. And we come up with something like this. So in December, $600 million went into the separately managed account at PFM. I had $116 million for the TAN, which we didn't get placed until January. It was just hard to find securities. 110 in FEITF term, and then we had a total of 252 in the liquid pool. And then and this shows when things are going to mature. So I'm laddering it out based on when we need the cash. And then in February, we were able to place another $236 million, which included part of a maturity to reinvest that. And then what I'm looking at is the chart some of you saw at the beginning of the meeting, this color-coded chart. And what we're doing is looking at how things are invested. So, and it looks different colors in my office. It should be solid red across here. I'm not sure why it shows with a rainbow up on the screen, but this is really for the amount of cash. And you can see where we're at right now. It's a much smaller amount because we've developed targets. I'm trying to keep no more than 2 weeks worth of money in the bank as cash. And that's earning interest. It's all interest-bearing accounts, but trying to keep that as cash. And then we have a month's worth in pools, and the rest of it's invested out. So you can see I'm already planning that in May, we'll have some maturities, and we'll probably be reinvesting those. So this year, we're trying to more actively manage the portfolio and have less money just purely in cash, and try to make sure we're making our money work for us as effectively as possible. So
You're having a hard time putting it out there, it sounds like.
we do. We do. We did in December. Now, I think in December, one of the things, it was just, part of it was just the market. Mm-hmm. You also have the same thing that we've been talking about, that you have less issuance for commercial paper and agencies. And some of the things we've been talking about, there's just not as much out there to buy. And everybody gets, in Florida at least, gets their tax revenues on the same day. We're all trying to get money placed. So it's challenging, and that's one of the reasons why I ended up keeping some shorter, and I know I'll be doing some reinvestment in May because I couldn't get it all placed where we needed it to be. So we had a little bit more in the bank in December than I would like, or in January than I liked, but we got it placed at the right time. So I just wanted to give you an idea of how we're managing this, and this is really for short term. The core portfolio is in here as well. Actually, this is just the short term. The core's not even here. So, and I apologize, the colors look so odd. It should be solid colors across here. It shouldn't look like rainbow columns, but we're constantly monitoring. This is the excess short-term funds, and I'm right, this is comparing to the target that I have. So I'm right where I want to be right now, but in May, I'll have some excess money that we'll want to invest. So what we've told PFM, we're going to send them, this is a roll-up of that first chart that really shows, here's my target, and shows how much excess cash we have, comparing the pool, and this is the amount to be invested in short term. And it goes up and down. There's days where it's higher and then it's lower, and it's not going to be perfect every day, but this is targets and where we're trying to get to. Now, eventually, a year from now, this is an ongoing project. I think that next year, we might be able to reuse this and not have quite as much in the bank and in pools. One of the reasons I'm keeping a month, it's actually a month plus 50 million in pools right now. There's a lot of uncertainty regarding the cash flows for the sales tax, when the money's going to be spent. A lot of that work is happening. There's a tremendous volume, and some of you are on the ISOC committee, and you'll hear next week. There's a tremendous number of construction contracts going to the board. Some went in February. There's a lot coming in March and April. There's a lot of work happening over the summer. So again, I want to make sure I have cash that I can get to on a day's notice to cover those expenditures, because I don't know exactly when they're going to hit. But we're still getting really good returns there as well. I go back to those rate indicators and how much can I get in a pool. Right now, on this day, the FEITF liquid was 260 and Florida Prime was 265. You have to go out quite a ways to top that. I can't buy securities unless you go out beyond 6 or 7 months. I can't beat the pools. So the pools are where I want to keep all the short-term funds. And then when I have longer-term money that can go out further, that's when the separately managed account works. So I just thought that would be helpful for you to see.
Let's talk about the FEIT a little bit. Mm-hmm. That's the one that was created among the school districts.
Right.
Right? And PFM manages that?
That's
Yes.
correct.
And so you manage what, the same way as you manage the other money that you have here?
We take a very similar approach. Obviously, we're buying different types of securities.
Yeah.
But again, it's definitely a relative value discussion like it is in the core portfolio, looking for sectors that are attractive, yields that are attractive,
Right.
with a focus on safety and liquidity, again, just like the core portfolio.
Is there any concern about, because it's such a small...
It's not that small anymore. FEITF is close to $3 billion in assets right now. And I've attached one of the things I've given you in your package that you've not seen before, and I wanted to take a few minutes to show you this. I've given you a package of information on FEITF and on Florida Prime. I know pools overall, the committee has expressed concern and wanted to get more information on them. And I promised to add something to the quarterly investment report.
Right.
Before I created something, I wanted to show you what's readily available from the pool and ask you if you want to see this much information or if you want me to summarize it some more. So for FEITF, there's a fact sheet that shows you how the pool is diversified. It's showing you how it's invested, very similar to what we do with our own investment pool. And then they show the duration. This is a comparison of the pool versus iMoneyNet, which is one of the indices used by pools. And then this is the summary. They provide a market update, and then they go into, here's the investments, and this is what it's invested in. And this is the pool, and you've got a hard copy of this in your package. And then they go into each of the term portfolios as well. So we can see exactly what they're investing the money in. We have a very similar document over here for Florida Prime. Again, this is as of December. And I'm scrolling quickly. They have $13 billion as opposed to the almost $3 billion with FEITF. Again, a short market update. This is how their portfolio is broken out. And this is night and day compared to what we saw with the old SBA when the state was managing it. This is managed by Federated. So they show exactly what the credit quality is, how much is accessible in a day, their top holdings, the maturity schedule, the portfolio composition, and again, comparing their benchmark to the benchmark. And they do go, I'm going to scroll, it gets right into this is what they're investing in. So when we talked about the information that we're reviewing for the pools and the information available, if you recall when this fund crashed, no one could find what they were invested in. It wasn't readily available. Somebody had to go down there and get a hard copy and make that available.
PFM
right.
started telling people.
Right. So this information is readily available, and we're monitoring it. Now, what we're looking at to build is a spreadsheet that compares the asset allocation for these pools to see how they're investing. But I think there's a value for you all to see this information. And I'm happy to have this attached as part of our quarterly investment report so that you can see exactly what's in those pools. And I did a presentation at the last state finance conference talking about you can't just dump your money in a pool. You have to know what's in the pool. And you have to understand how it works and make sure that those investments align with your own investment policy and
Yeah.
make sure you're comfortable with it. Now, FEITF, one of the things that gets thrown out all the time, we have the liquid pool and then we have the term pool, and I have money in both. I add them together and compare that to the requirements in our investment policy. Technically, they're separate funds, and I could treat them separately, but in my mind, it's the same company managing them, so I add them together. So I'll never have more than 25% of our cash in FEITF or more than 25% in the state pool or in Florida Prime. And quite frankly, those numbers are lower than that right now because we have a lot more invested.
Now,
in
this time of
securities.
year, presumably there's more in those pools.
Yes.
In other words, the $3 billion is a high mark probably, and so, or close to high, and probably
The
13
low
billion.
point's about 2.
Yeah, and the same thing with the Florida Prime.
Florida Prime, it fluctuates. I don't know that it fluctuates as much.
Yeah.
Now, the interesting thing with FEITF, and by the way, I should mention, they have their own investment advisory committee, and I'm a member of that, and I was just recently elected as a chair. So that started last week, I think. So I'm going to take even more closer look at how this pool is being operated. But about half the money in FEITF is schools. The other half belongs to cities and counties and special districts.
Oh, good.
So it's not all schools.
Okay, I was
so
afraid
you
of
don't
that.
see
Right.
the big drop and change because school districts' cash flows are very predictable, and we know exactly what's going to happen. So bringing in all these other entities has really helped diversify that pool.
Yeah, well, that's what I was thinking. I mean, my concern here really, I'm not sure I'm in the right position on this, but we saw what happened with the big Florida Prime.
Right.
And a lot of it depended on what the needs of the members of the Florida Prime, who can invest in what their problems were. I would think the same would be true with school districts, who all have the same, may have the same problems or
Right.
similar problems,
Right.
or similar cash flow needs. It seems to me that creates a certain risk. As you say, you're diversifying that
Right.
risk in the school district. But even Florida Prime has got its own risk, as we found out previously, because its members are sort of dependent on the same things.
Right.
Is there anything else that could be where you could invest that is almost as safe, that has a broader
No.
case?
No. Unless we're just buying the individual securities, which is
Yeah.
where we're trying to diversify that, and that's the biggest portion of our portfolio right now.
Mm-hmm.
But there are other pools out there, and they have a much higher percentage of corporates. And when we look at them, they're still safe. They're just not as safe. I'm trying to be very conservative with these pools. I
Well, I
want
know,
to make
but there's
sure
a
that.
certain insecurity in being too safe and too small. That's what I'm getting at.
Right,
If you don't have enough diversity of the people who are calling on that pool,
right.
as we found out. I think I'm right on that.
Well,
Yeah, that's right.
we can't invest in pools in other states. And money markets now have that floating net asset value, so it's not something I'm comfortable using for short-term money. So you really have the bank, and you have pools, and then you have specific securities in the separately managed accounts. And I can go out and tell PFM I want to invest money for 30 or 60 days. And we can do that and do something very short. The rate on that will be less than the pool because the pool is buying things that have a longer maturity and they're spreading things out. So we're getting more diversification by using the pool than we would by buying individual securities on our own. We are buying securities on our own as well. We're doing both. Typically, it's the shorter term money is in the bank and in these
And these
pools.
term versus the short term, well, how long is that? And you have to keep it in for a certain period in the term part of the pool.
With a term product, we tell them that I have money I want to invest for 60 days, or in this case, the money, the $110 million that's in the term product matures in June, just in time for us to make the debt service payments. So they're buying a specific bulk of securities for us that will mature on a certain day.
Okay, so they're doing what you would otherwise do.
Yes. A lot of school districts and outside cities, counties are looking at that term product. Because if they don't have the ability to go out and invest the way we do, where we can go and buy a block of treasuries or agencies, they can say, I've got $100,000 that I want to invest for 6 months. And they may not have an investment advisor that's buying securities for them. So that's the way they get at those, basically replicating a separately managed account. Did I say all that correctly?
Oh, yeah.
Okay.
I don't even need to be here.
I think we did a good job with how we're allocating things out this year. We still have work to do, trying to get to, I'd like to get to where we have even less cash in the bank, but until we have really strong cash flows, and I'm not sure we'll ever really get there on the sales tax projects. They're very different. It's not that we're building a school and we know and we are building some schools, but most of it is not schools. It's roofs and air conditioners and flooring and painting, and those things are not as predictable when the companies are going to build, when they're going to bill us. On a construction project, I've got a nice little S-curve that shows exactly when we can expect bills to come in. It doesn't work like that with these projects. We're replacing air conditioners at 50 schools. I don't know when we're going to get billed for each one. And it's just hard to figure that out. I mean, the construction staff are working hard to schedule the work, but then when is the company going to bill? We've ordered air conditioning units with the last equipment lease that we did in October. Those are just now being delivered. And then they have to be scheduled to be installed. And Trane will come out with a big Trane, and there's 3 or 4 companies. They come out with big cranes, they lower those chillers in over a weekend, and then we'll get a bill. But I don't know when that's going to happen. So I have a lot more cash that I need to keep very short term so that we can pay those bills when they come in. But we'll continue to work on that and try to shrink that and get more invested out with longer term securities. Are there any other questions on the investments? I know we spent a lot of time on it today. I just wanted to make sure we covered everything that was going on.
I guess we go to the policy review then?
Right, and I did a PowerPoint presentation, if I can find it. Oh, there's a
While
question.
Leanne's looking for that, I'd just like to introduce Ms. Wanda Paul, our Chief Operating Officer. She's joined us here, special guest. She's helping us spend a lot of this money.
She is. Okay, so I did a short PowerPoint presentation, basically going through each of the policies. And all the policies, you have copies of them. We went through them at the last meeting, but I just wanted to summarize the changes that we have. So for the debt management policy, there were no recommended changes after the last meeting. There was a typo that we fixed. But basically, we've eliminated some duplicative language and cleaned up some things to make the policy a little easier to understand. We've updated the language regarding hedges. Since all the swaps are terminated, we basically gone back to scratch and what we'd like the policy to say, because the policy for swaps was built after we'd already started issuing them last time. So we made a little change, but not very much there. We've updated language because on bond insurance, because bond insurance in most cases doesn't really add value. Our credit rating is higher than them. So we added language in there regarding when we would do that. And just the dates of the last credit ratings, they haven't changed, but the chart has dates of when they were updated, so I updated that. For the guidelines, again, some minor language changes. Every time you read one of these, you find a typo that you hadn't caught that's been there for 20 years. And so every time we read it, we try to catch more of those things to clean up the language. And also adjusted the language on hedges since the swaps are gone. The procedures, we added in the new language from 15C to 12 because there's some new events that require disclosure. So we've added those in, and the language regarding voluntary filings. On the cash and investment policy, we had language in there on supranationals, and they were, I believe, at 25% and 5% per issuer. The committee said they wanted no more than 10, so I've made that change. And I've also limited the issuers to the International Bank for Reconstruction and Development, the World Bank, International Finance Corporation, IFC, and Inter-American Development Bank, or ADB. That was the top 3 that we talked about at the last meeting. AAA ratings required, the maturity limit's 5.5. I also added some language in here regarding interest-bearing accounts. That was not in the version you saw at the last meeting. Somebody in my office I've got a lot of people that are either new or in new positions, and they're reading through policies, and I'm asking them to dig into things and look for things. And she said, well, where does it say we can put money in interest-bearing checking accounts? It talks about having to have checking accounts, but it wasn't specifically allowed in policy, so I added it in. I think it's understood, but I would hate for somebody to come back to us and say we don't have the authority to do it. So I've added language in about checking accounts. And I've also added language that you did see, increasing the maximum allowed in pools to 75 and 25% per issuer. I also added the language you requested the last meeting, that the 75% should be used sparingly with a goal of 50% or less invested in pools. That we'd only go up, and I don't know that we'd ever hit 75. The 75%, it could happen when our cash is at a low point, and 75% is a lot less than it is right now. But we could run into an instance for a month or two we might need to have more in pools.
When you have very little in the bank.
Right. It's just the low point in cash. So it's not a lot of money in pools, but the percentage goes up because our total portfolio shrinks. So I added that language. That was something you asked me to add in, and we got that in there. Finance committee policy, that I have no proposed changes to that. It looks fine as it is. And then the advisory committee policy, this is ones where the board office has recommended some changes. And we talked about this last time. They require resumes for proposed committee members, and those go to the school board to be approved. So the school board is approving them based on the resumes that's submitted. It does clarify the process for handling potential conflicts, that instead of just calling general counsel's office, you're going to call the Department of Ethics in Tallahassee. You can send those to me, and I may call Blair, and he's going to give me the phone number for the person that you need to talk to in Tallahassee. It also adds language regarding the district's lobbying policy, and it requires that meeting information be posted in board docs, which is what we're running the meeting on. I did want to bring up, we haven't had a meeting on sunshine for this committee in a while. We do it every couple of years. All of you have been committee members for a long time, so I don't do it every year, but I don't think we've brought back the lobbying policy. I don't think we've discussed that with the committee. So I want to schedule some time, and I've already mentioned this to one of the other attorneys, Bruce Harris, and that he's happy to come in and give you an overview of that policy, because I don't think we've done that. I don't know that it impacts any of you, but I'd be remiss if I didn't offer it and make sure you all have that information. So we'll schedule that at a future meeting.
So the conflicts can't, you don't handle the conflicts per se any longer? Or is it, we have to directly deal with the state ethics?
If you had a question,
right.
Because we don't represent you,
Right.
we don't want to get into a position, and you can't rely on our advice, because
too bad.
if we want to send you to the place where you can rely on the advice that you get, which is generally going to be the Commission on Ethics.
So even your school board members don't go to you on
we do not represent the individual school board members either.
When
we
the conflict question comes up,
so same thing. Again, our advice, we might say, we don't see a conflict there, and then they get in trouble. And our advice is, is not what's going to carry the day. It's the Commission on Ethics.
Wow. Doesn't that make it a pretty difficult process to get it?
It's actually, we had somebody on the Construction Oversight Review Committee. We did the same thing with them a month or two ago, and he was referred to the Commission on Ethics. He got an answer back within an hour. He was really impressed in how quickly the person got back to him, and had a great experience with them. So I don't think it's going to be a problem. It's just different.
Yeah, I'd say it's different.
The Commission on Ethics, their attorney up there is a really good guy. He knows his stuff, and when we have questions that we ask him, he is extremely responsive. And as Leanne said, I think the court member had an issue, and we've referred board members up there as well, and they've gotten answers to their questions.
In the conflict setting, let's say we all have a conflict here, it has to be recognized. So it means that the attorney, Blair, or whoever is sitting in the room, has got to be able to recognize that possible conflict.
Well, we also asked the committee members, there is the ethics presentation that's available online for you to watch that kind of goes through potential conflicts of interest, and we do rely on committee members to let us know when there's a potential conflict.
I just can't possibly believe that we can't get advice from counsel here on possible conflicts, or that it can't be perceived that there's a conflict, rather than that we have to figure that out ourselves. I mean, that's a lot
Well,
of
if there's
burden.
something that comes up and I'm aware of it, that there could be a conflict, I'm going to talk to you individually and say, this might be a conflict,
Right.
and recommend that we go to the Commission on Ethics.
That's what I mean.
Yeah.
You do that, presumably. In other
Sure,
words,
if,
right. I mean, if you
if
see
if
somebody.
I find out that,
Right.
that you've taken a job at
Right.
one of the banks, I'm going
Right.
to say, hey, Rick,
Yeah.
I think there's an issue there, and before you proceed, I recommend that you do that. That's,
Or
but-
recusing, board members or whomever, or members
Right,
here,
but that's
recusing themselves.
different
and
than
saying,
telling you that you should or you shouldn't. And, most of the times, the person is asking for advice about, oh, that's not an issue.
Yeah.
And if we give that advice and somebody files a complaint against you and you are found to be in violation,
Yeah.
you're going to say, hey, I relied upon the Office of General Counsel's advice, but we don't, the
Used to
very
be a
first
protection.
point, we don't
That
represent you.
used to be a protection. That's really what I'm getting to. That people who would turn to their own organizations and their own counsel and ask for advice and got the advice, they were then protected, from liability, basically.
Right. But again,
that's no longer the case. is
we
what it
can't represent you. We don't represent you
Yeah.
and as individuals, and you don't want us to. You don't want to have to give us all of that information, which then is potentially public information, because once you hand it over to us, once you tell us all of the little details of your personal life.
But isn't that
That's-
what happens when you provide the resumes for committee members and things like that? I mean, that's
Well,
really what I'm thinking.
I don't, I mean, in the case of the ethics
Yeah.
question, it's getting into the very details of,
Yeah.
whatever the situation is that
Yeah.
brought up the question in the first place.
It's not so much that I'm thinking of personally, I'm just thinking of it generically, that people have conflicts all the time, and it's usually the organization that recognizes the conflict rather than the individual. Sometimes it's, it should be the individual in many respects. But
Well, and we
oftentimes
can
it's
still do that. If we're aware of an issue, potential conflict, we're going to flag it down and say, we think this is an issue, and we're going to refer you to the Commission of Ethics, and that way you can make sure it's okay, or that it's not.
I know it's true at Palm Beach County, they changed their policy so that you couldn't even serve on a committee if you ever did any work for the county. And basically, you were just out if you did work for the county. I don't know if that's true here, but it's the kind of thing that you wouldn't know, generally speaking.
So there is on the board website, there's a link for advisory committees, and right there is a video that's produced, I think, by the Ethics Commission. I think we changed it. It's not a school district video anymore. It's broader. It talks about advisory committees and what you can do, what you can't do, and what could be an ethical conflict.
Good.
So, and we require that all new committee members have to do that. At the school district, we have an ethics policy, and I have to watch the video every year, and I think it's good for everybody to see it every year. It's just a reminder of what you're allowed to do and what
And
you
we
can't
probably
do.
should have that, so we know. I mean,
I can send you all the link
we're
if you
being
want to see
charged
it.
with that responsibility, we should know what it is.
Well, I can send you all the link for the video. You can watch that at your leisure, and I'll certainly set up a time for Bruce Harris is going to come in and do, unless Blair wants to do it, but it's usually Bruce that comes and does the update on sunshine and lobbying, and we'll arrange that. I will try to do it at the April meeting. I'm going to look at the agenda. There's a lot of things coming at the April meeting. I see Mr. Burke raising his hand.
I want to make one more introduction. We have Ms. Amity Schuyler, our Chief of Staff here. This is the Finance Committee, meet Amity. Amity's up for a big award today. The Women of Worth out of the Central Chamber.
Oh.
So we're hoping she brings home the hardware.
Congratulations.
Okay, good.
Okay, did you want to dig into any of the policies, or are you okay with the summary? You have the hard copy in front of you. I hate going through and reading these things line by
I
line
think we did
with
it,
you.
didn't we do that before?
We did to some extent, and I gave
think
you
we went
another
through it.
set of hard copies.
Right.
They're available online. If you see any changes, if you see any typos or anything, please let me know, and I'll be happy to make the change. It takes, once we're ready to go with this, I'll get it scheduled to go to the board, and it goes to 2 public hearings, and there's a workshop, and then there's a public hearing for a development and then for adoption. It's at least 3 months once the process starts to get the policy changes. None of these changes that we have is super time sensitive. It's just things that we need to address. So we're following, like the procedure changes don't even go to the board. We'll just make those officially. And the guidelines are subject only to the finance committee. So those are official. So we're essentially following the guidelines of the policy anyways.
Do we then approve what we have?
Yes, we'll need a motion to approve those.
all of them?
So moved. Second.
Second? Any further discussion? All in favor?
Aye.
Passes unanimously.
Okay, and I'll just point out again, the meeting in April is scheduled for April 26th. We'll have quarterly investment reports. We'll be talking about the proposed TAN sale, the proposed sales tax financing, and I think we'll be bringing in the proposed COPS issue as well. We've been pushing these things off the COPS issue's been postponed for 2 years now. But I think we're getting close and ready to do that. So April's going to be a busy meeting. The TAN, you see that every year. There's nothing new there. The sales tax financing, we're probably going to be putting out bids for that soon to get quotes, because unlike a COPS issue, y'all can approve it and then we go and do the negotiations and sell it. Whether we do commercial paper or line of credit, that would need to go to the board in May, and all the terms have to be negotiated up front. So the plan is to send out bid requests, get quotes in, and get information from the banks, see what they propose, and then we'll bring that back to the committee based on whatever's the most effective. I'm ambivalent whether it's a drawdown line of credit or a commercial paper program, whichever one is most cost effective.
So it's going to be short term. It's
It
not
is
going to be
short
like the term one we did.
It is not a
previously.
bond. It's going to be, what we did last time with the last sales tax,
Kind of
we did
2
a line,
year.
we did commercial paper.
Yeah.
And it was a line of 300 million. We may do commercial paper again. I think my last guess, and I've just got new numbers in from facilities, and I haven't looked at it yet. I told them I'd look at it on Monday. So they're still tweaking. But I'll get that, and that's what I'm going to use to forecast how much we need. The last time I looked at it was 200 million. So it's less than last time, and it's a much larger sales tax. But the work is being done over 10 years. I mean, even though we're bringing money, advancing money to expedite work, some of it still takes, 10 years. There's technology in there that we're replacing now, and then in 5 years, we're going to replace it again. So that money doesn't need to be advanced. So we're working through that. Hopefully, I'll have those numbers for you, and we'll be ready to go. We need to have a facility in place by the end of June. So that will be coming to you in April and going to the board in May. So April's going to be an interesting meeting. I hope all of you will be able to attend.
All right.
Lots to talk about.
Anything else?
No.
Any other members? If not, we're adjourned. Thank you all.
Thank you very much.
Good to see you. I liked your, I appreciate it.